Good morning. It's about 2.5 hours into the market. And so what happened yesterday is exactly what we're talking about. Market came down and it hit pretty much bottom or close to bottom. And it came back up and it wound up in this area. And that's what we had mentioned. That's what markets do. When they start coming down this fast, this hard, early in the morning, and it's getting close to the bottom, there's no other place to go but to retrace and come back up. All markets retrace, so we already talked about that. And let's see, the market started there and went down to there, and that's where it retraced right into this red area, and that's what the market did. So this is a classic move right here, what the markets do. So today, the Feds are going to decide whether they're going to raise interest rates or not. So it's not going to make any difference to me because this it's going to be in an hour and a half when they come out and make the speech. So the market's going to bounce around for the first hour, let's say, and then it's going to find direction maybe by tomorrow, and then the market will usually go in that direction, unless it starts coming up to the top and starts balancing. So right now, this is in the middle of a balance area. So if it stays here in the market and the Feds make a speech, and the market decides to come up and hits this top up here really fast, this would be a good short right here. And the reason for that is because, like I said, when the markets come down really fast and hard like that, they always retrace, unless it's a trend day, and it's already too late for a trend day. So if the markets come up here, like I said, especially on news, chances are about 90% chance it's going to reverse and then start coming down for the rest of the week. Now, there's a good 90% chance will happen. The other thing is the markets might come down and do the opposite and come down and hit the bottom. And if they do that, they start hitting support, then they could reverse and turn up. But since I think most of the energy or momentum is down, on the larger scale, that if this thing does come down, chances are it might come back up, but that might be the indication that this is going to start coming down big time. So a couple scenarios that can play out, and I'm not sure what's going to happen yet until it actually starts to happen, and then I can feel the market at that point. So here's the Dow Jones, and this is a daily chart here. So the market is back up into this area, and this is where it's at. It's like kind of in the middle of this big balance area. And so this can go anywhere, but like I said, if this market shoots back up here, there's a lot of resistance up in this area. And if that market comes up and hits this area, as soon as the report comes out, then that would probably be a good short right in there. So, of course, I'm going to be watching all the indexes, and they need to be pretty much in sync and doing the same thing. And same thing with the NASDAQ. NASDAQ is pretty close to this top, and if it pops up and stays here, even pops above it, and then hovers there for a while and starts coming down, then that would be a good short also. And again, all these markets, these indexes have to pretty much do the same thing. So Russell's the only one that's really close to its bottom. I mean, this is the all-time bottom right here. So it's really close. I believe when the market does come down and hits this and even goes beyond, it's probably going to come back up and stay in this area for, I don't know how long, maybe a couple days, a week or something. And eventually it's all going to break down. All these indexes will break down. And but the question is when. So we don't put our money on the when. We put our money on what's happening at this moment. Unless you're a long-term trader, meaning that you're in for 6 months or something. But since I'm a swing trader, I want to make sure that these markets are going to move in that direction within either a month or two. And of course, if you're a day trader, you want to make sure that market moves that day. in your direction. So that would be a 5-minute chart right here. So there's a 5-minute chart. This is on ES. And no trade here, nothing going on at all. And that's pretty typical for a day like this because, like I said, everybody thinks this is a big day. The interest rates are going to either pause, maybe go down, or maybe go up 25 basis points. And so I can just tell you from experience, it's just a big game. No matter what the Fed does, it's not going to prevent these markets from going down. You know, eventually they will go down really hard. But you know, the Feds are just playing this game. At this point now, I mean, the damage is already done. They've had interest rates pretty close to zero for so many years. So damage is already done. And no matter what they do now, it's almost like trying to steer a huge ship with a little tiny steering wheel. It's not going to make any difference, at least not in the long run, in the long term. Short term, yeah, I mean, it's good for day traders, you know, if the market starts coming up, and also swing traders. But long term, you know, I'm thinking by this summer, this market's going to start heading down really big. And there's nothing that's going to prevent that. However, they do a really good job of telling the public that these markets are strong and we're going to be back in a bull market soon. And so you got to remember 90 to 95% of people lose money in these stock markets. And if it wasn't for those people losing money, these markets could not exist for the 5 or 10% that are making money. So that's how this works. 5 or 10% make money, 90% lose. So those 90% of people have to lose money in order for these markets to work the way they were designed. So that's why this is, you know, pretty much a big joke. But I understand the game and I understand how it's played. And if you follow along, then you'll understand too. And you can actually make some really big money on this thing, especially when it starts heading down. Okay, so that's it. There's not a lot to say. Like I said, the market in an hour and a half, the Feds are going to make their speech, and it's going to be the same old story. It's going to bounce around, maybe even take off really big the first, 15 minutes, and that to me would be a really good short coming down. Or the opposite could happen. It could come down, and then it might turn around and come back up. But again, this could be the beginning of, if it does go down, of a nice little downturn here. But still, even if it did come down here, I would say there's a good chance that it would retrace. But it could come down and stay. You know, like I said, this could be the beginning, because this is already drawn out at least 22 days. I think it's 23 days now. It's longer. Here's a 24-day. It's time for this thing to come down. You know, so it's got all that against it, plus it's really big resistance up here. So you can actually literally buy put options anywhere in here, you know, longer term, and just ride this thing down. But I'm going to leave that decision up to you. You decide what you want to do. But I've already given you all the different scenarios which could happen and which probably will happen. I mean, eventually, like I said, it's inevitable these markets are going to come way down and break these bottoms and come down. And we're not even close to a bottom. We're far from a bottom. And we might hit bottom, let's say, in a year. I don't know how long it's going to take. I don't know how long they're going to drag this out. So, as I mentioned before, you know, here's this chart right here. So I'll blow this thing up. And this is pretty accurate, you know, as far as how the markets go up and then how the markets go down and how they actually channel here. They balance out in this area, and that's exactly where we're at. We're probably about right here right now. And then the markets start to drop, and there's a lot of complacency, like they said, because I've talked to a lot of people and they still believe that we're in a very strong economy and it's going to go up, and they're hanging on to their 401s because it's going to keep gaining value. And as long as that's there and those people believe it, these markets, that's what this complacency is all about. And eventually, when it starts dropping, people get anxiety. They might question a little bit, you know, but they're going to be in this denial mode all the way down until it hits the 70% mark, what I call 70%, because these markets, when they come up in a bull run, let's say it takes 10 years to come up, when it hits the 70% mark, that's when everybody starts jumping on board, and then that's when the markets almost go parabolic. And you can see that happening right here. And it's the same thing going down. People just refuse to believe this market is going to go down. And all they have to do is look at history, 2008, 2093, I don't know, 87, you know, in the 70s, 1929, all the other crashes in between. There's lots of them. And you can see it's the same pattern that plays out. And then there's panic, and finally it gets down here. Most people are wiped out. And then it starts up all over again. Same old cycle. And this is what I saw in 2000. And I saw the same thing in 2007. And I think I mentioned this before. In 1999, I joined a stock group, and that's when I was starting to analyze cycles. And I was telling everybody there that the markets are we're in a bubble, it's going to crash. And they eventually kicked me out of the stock market. I mean, out of their stock group. So, you know, the rest is history. But anyway, back then is when I started to analyze charts and cycles and to see how accurate they really are. Okay, so that's where we're at now. I'm going to end this, so I'll talk to you guys tomorrow. Let's see what happens today.